Okay, I think we're ready to go. Hello, everyone, and thank you for joining us for the Effects of the Hardening Excess Market webinar. My name is Joshua Rogov, and I'm the president of CR Solutions, a third-party wrap-up administration firm. And if you follow the hard market on Instagram, you may have seen me on their recent post, Bald Man to Host Hard Market Webinar. Well, I am that bald man. If anyone has a question during the presentation, please use the Q&A button on the bottom of your screen, and we will try to get to them at the end of our presentation. CR Solutions specialize exclusively in wrap-up administration for large-scale construction projects. We've been serving the construction risk management industry since 2002. Today, we have an all-star panel who will be talking about the current market conditions we are all unfortunately dealing with, as well as discussions surrounding the cause, effect, and future expectations for this hard market. We will then close with some solutions from our panelists before taking questions from our audience, time permitting. Each of our panelists today bring their own unique perspective and experience to our discussion, from insurance carrier, both primary and excess, to construction manager, to developer, owner, builder, property manager. Our panelists today are Steve Buonpane from Chubb, Stephen Buonpane from Chubb. Steve Buonpane is Executive Vice President, Construction Industry Practice Leader for Chubb Major Accounts and oversees underwriting for Chubb's primary and excess casualty construction divisions. He has been with Chubb since 2009 and started his career in 2003 at AIG as a primary construction underwriter. Prior to joining Chubb, he spent 21 months on secondment with the British government as UK Trade and Investments US Financial Services Sector Lead. Mildred from AECOM. Mildred is a Vice President for risk management at AECOM and has over 16 years of industry experience with AECOM Tishman, construction manager of the world's most iconic buildings, defining the skylines of the world's most notable cities. As Vice President of Risk Management, Mildred is responsible for contract review and contract insurance review for all AECOM Tishman projects and manages all insurance programs, including contractor-controlled insurance programs, builder's risk, pollution, construction managers, professional liability, railroad protective liability, and subcontractor default insurance. Mildred also serves on the board of Women's Builder Council. Jonathan Luca from Starr Companies. Jonathan Luca is Vice President, Profit Center Manager of the Excess Construction Division at Starr Companies. Starr Insurance Companies is a leading insurance and investment organization providing commercial property and casualty insurance across the world. Jonathan has over 17 years industry experience starting his career at AIG, working in the excess casualty division. Jonathan has been with Starr Companies for the last 12 years in the excess construction division. Bryan Paul from L&M Development Partners. Bryan Paul is a senior insurance manager for L&M Development Partners. L&M is a vertically integrated affordable housing developer, owner, builder, and property manager. Bryan has over 10 years experience for risk management in construction. Last but not least is our special guest, who I'm honored and starstruck to be in the presence of, the anonymous Instagram sensation, The Hard Market. The Hard Market began in November 2019. A product of its half-drunken creator's imagination, it has grown over the last 18 months into, well, no one really knows what it is quite yet. What is known is that there is a community of nearly 12,000 followers stopping by for a laugh at the state of our market, the effect of COVID on our jobs, and the never-ending, unmitigated gall of alphabet houses. There is also a sense of responsibility to share ideas and insight, the occasional coverage tips, and to promote thoroughly non-boring webinars such as this one. The Hard Market regrets that no identities will be revealed, so the creator can maintain gainful employment. If you aren't following them, go follow them now. Well worth it, I promise. Just a note, we will be sending all registrants a copy of the slides, the webinar recording, and a PDF with the questions and answers from today's session. So let's begin. When did this hard market begin? Let's start with the carrier perspective. Steve, we're going to start with you on this one.
Yeah, so I'll start. I'll give a perspective from the primary lines first, and then I'll kick it over to John Luca because his thoughts on excess is what I'm sure everybody wants to talk about today. But so I'll be brief. But if you look at the data, and if you wanted to find a hard market as when rates started increasing consistently and on a broader scale, it really started around the second or third quarter of 2018. So that really means we're about 3 years into this cycle. Though I would say the acceleration in higher rates, higher retentions, higher attachments, that's really taken hold in the latter part of 2019. And we'll talk about the factors behind this market in a bit, but there are sustained underwriting losses over the last few years, namely for GL and auto. But all else being equal, we're really only seeing modest rate increases on the primary lines. So disclaimer there, primary lines, right? Mid-single digits on the GL, a bit higher on the auto, depending on your fleet makeup, depending on your loss history. So about low double digits there on average for the most part. And workers' compensation results have been very stable. Comp performance has really held over the last 5 to 6 years. But this is an excess panel. And this market cycle is not really about what's happening down low on the primary placements. Yes, rates have increased, retentions have increased, especially as there's been a need for higher primary limits. But the reason for those higher limits really all comes down to what's been happening in the excess layers. And so, John, Luca, that's your cue.
All right, thanks, Steve. Yeah, I think what Steve said is exactly right. Hard market began mid to late 2018, where at this time we started seeing carriers increasing rates. Carriers began to reduce the amount of capacity they use. And also underwriting appetites began to drastically shift in certain areas. We started to see the larger rate increases, the larger capacity shrinkage in 2019, and then that's continuing on until today. I think for carriers, for them to remain in a specific discipline, such as construction, the carriers felt they had to raise their rates, in order to achieve or to maintain profitability. And, also at this time, the reduction of capacity by several carriers was a large impact. What used to be a $25 million layer really started turning into a $10 million layer. So with this reduction of capacity, it started to require a lot more carrier participation when you're building these larger capacity towers. And with the participation dropping from carriers, there was a large void. In the lead excess space, we started to see a trend with the expiring lead $25 million chunks turning into $10 million policies, roughly same price or sometimes even higher. With this lead pricing dramatically increasing on the shorter limits, the higher excess layers began putting a premium on their capacity, which was making an overall excess tower premium substantially grow. And then another contributing event was what we saw with the shift in underwriting appetites, whether it be carriers exiting certain lines of business, carriers tightening terms. The excess market wasn't really as predictable as it once was. Carriers started to require higher attachment points, like Steve mentioned, on certain classes of business. For example, auto, excess auto underwriting. I don't think it's breaking news, but that's dramatically changed over the last few years. So Josh, you had all these factors colliding at once. The market quickly began to harden, and I think it continues to harden at this time.
Great. Thank you, Steve and John. And from the client perspective, Bryan, anything you want to add? And then we'll go to Mildred.
Yeah, I agree with John and Steve about it starting about 3 years ago. We've been collecting subcontractor policies for about 8 or 9 years now. And about 4 or 5 years ago is when we really started to see the limits and coverages really start to narrow. You no longer see per project endorsements anymore. It's a per project endorsement on the policy, and then there's a second endorsement with a max limit for the policy period. On the excess layers, you're seeing their own set of exclusions now too, instead of following form, the underlying. I've seen height exclusions on the excess layers, exterior and interior. There's sub warranties on the excess policies. There's additional insured privity issues on the excess policies now too. So we really started seeing that about 3 years ago. And now that the excess market has been fully tightened up and, coverage is completely narrowed and limits are reduced to what the most they could be, that's really when you're starting to see rates starting to increase, because that's the only area where you'll see the market react to. So
Thanks, Bryan. Mildred, anything you'd like to add?
Yes, I agree with everything that Steve, John, and Bryan just went through. What that translates to us by way of the client is it's a dramatic increase on our total cost of risk. We've gone through a handful of renewals since the market began to shift. And everything that Steve and John talked about resonates between restructuring the primary Changes on the excess where, yes, you had a block of $25 million. It's now $10 million, but there's still rate increases on those. We've worked on a couple of non-construction programs this year, just went through the renewal in January on an account that the lead excess was looking for greater than 50% premium increase on an account that had no losses and essentially had no revenue for 9 months out of the year. So it is it's a challenging topic, and it's definitely very hard to articulate and communicate that to those when there are no losses, and it's a greater shift, and it's impacting, I would say, almost all of our lines of business that we work through.
Thank you. And I could add, just from the CR Solutions perspective, we touch many subcontractors, and what we're hearing more and more often is subs are just even having difficulty obtaining the coverage. So it's not even the cost being an issue, it's more availability. We recently were dealing with a subcontractor that was required to carry $10 million of limits, and they were just stuck at 8. They couldn't even get that last 2x of 8. So it's definitely affecting the market overall. Hard market, anything you'd like to add?
No, nothing specific. I mean, I would say that it is, the timeline's right. Late 2018, you noticed renewals becoming uncomfortable. By early 19, you noticed that your clients were pissed at you most of the time. And everything was more and more difficult to fill out. Every tower was more difficult to do. And that's just, you could sense it was coming. And by the end of the year, it was fully here.
Great, thank you. So let's go on to what are some of the causes of this hard market? And we'll go back to Steve on this.
Yeah, so I guess a few things. For a hard market to exist, you really need 3 things to happen. The first being inadequate loss reserves, the second being inadequate profitability, and the third being inadequate capitalization. And I want to touch on the first 2 and then get back to the industry's capital position, because that's a bit of an anomaly, at least with respect to this market cycle. But inadequate loss reserves and inadequate profitability, you might think those 2 are related. Yes and no. There's obviously a correlation that's there, but when you have to strengthen your reserves for adverse loss development, it doesn't necessarily mean that insurance companies are not profitable. You can have an underwriting loss, which tends to happen when you need to increase reserves, but you can still operate profitably if the investment income can offset it. However, when we're operating in a historically low interest rate environment, the investment income isn't really there, then that puts more pressure on the underwriting results to get to your required ROE. And underwriting results have been very poor in a number of areas. So according to the institutes, from 2007 to 2013, the auto claim severity rose at an annualized rate of 1%, just 1%. And then from 2013 to 2018, severity rose at an annualized rate of nearly 11%. So from 2007 to 2013, just a 1% severity rate increase compared to 5 years later, an 11% annualized severity rate increase. And we said that rates started to creep up in 2018. The number of class action suits that U.S. companies have handled in 2020 was nearly 4 times as much than it was a decade ago. The number of verdicts and awards of over $20 million is up by more than 300% compared to the annual average a decade ago. So very simply, claim costs have risen at a much higher rate than what was assumed when policies were originally underwritten. That's key. So therefore, you have inadequate loss reserves, and then low interest rates on top of that are leading to both underwriting and operating losses. But where things get interesting here is that we don't actually have inadequate capitalization. Policyholder surplus in the US P&C industry has never been higher. I'm going to repeat that. Policyholder surplus has never been higher. That means the industry is well capitalized, the supply is there, it's just a lack of willingness to use that supply or deploy capacity. And that's because of the massive loss increases we've seen from a severity standpoint. But balance sheets are healthy, right? The capital is there. Putting out large excess limits, however, it's just not sustainable in this environment. And basically, insurance companies are saying, we would rather spend $1 billion buying back our own shares of stock than put out another lead $25 million limit.
Thanks, Steve. So let's hear from the panelists how the hard market is affecting different insurance products. John, we'll start with you.
Sure. So is in the excess space, you have a practice policy and your project policy. So I think the practice policy space, we've seen the large rate increases over the last few years on virtually all classes of business, magnified by the tougher classes of business. And again, on the difficult classes, there's not only been the shrinkage of capacity, there's also the markets who have left the space. So similar to your story, Josh, where you have a contractor who just could not find coverage, that's becoming a little more common. As the brokers are trying to replace these markets, these increased rates, along with the scarcity of markets on these tougher classes, just the dramatic changes behind a practice policy from 2018 to 2020, it's just phenomenal. And this includes all the terms and conditions changes as well, like Bryan was talking about with height exclusions and capping per project ags, capping aggregates. Once you have auto involved on a practice policy, the hardening's even more. The verdicts in this space have just been massive. And you couple that with the increased frequency in auto, carriers have, and they're going to continue to raise rates, in this area to seek profitability. And practice policy space in all venues are affected by this. New York, clearly one of the most difficult venues for underwriting companies to remain profitable in. We've also started to see hardening in other states recently, Colorado, state of Washington, and a few others, all based on recent large unpredictable verdicts. But from a venue standpoint, and for good reason, New York seems to be the hardest for small, mid-size, and large business on practice policies. And then once you get to the project space, again, large rate increases, capacity reductions, similar to the practice policy. Certain venues, a lot more difficult than others. Florida, Colorado, New York, very difficult to find capacity in on project specifics. Capacity shrinkage probably hurt this product the hardest, just based on the fact of the amount of limit that is purchased in this area. So larger projects are buying 100 million of capacity. And you used to be able to achieve that with 4 or 5 carriers. Now to build 100 million in tougher venues, you may need double the amount of carriers than you used to. With each carrier wanting to maintain their larger per million layer pricing. So again, you have more carriers seeking larger per million layer pricing, just driving the overall up. When you look at a large two-line wrap, $400, $500 million carriers, excess carriers, like Steve alluded to earlier, have been pushing for increased attachment points and in some situations, better aggregate structures for the excess carrier. In New York, a 5-10-10 attachment is pretty much turned into a mandatory requirement, which is pushing more pressure onto the insureds for the larger retentions and the primary carriers putting up more limits. And the carriers that are willing to put out the larger GL limits, maybe looking to the facultative reinsurance market for this capacity. But similar to the direct space, the facultative space has shown this tightness again, all for the same reasons. Less players, the remaining players are charging a lot more than they once have. So this increased attachment requirement also is putting pressure onto the buyer, like Mildred mentioned earlier. The larger retentions, larger deductible levels are being required by the primary carriers in order to put up the more limit. And these larger retentions again start to create increased collateral requirements, which is another factor to consider when clients are moving forward with this product.
All good points. Thanks, John. So Mildred, we'll go to you with a high concentration of work in this area where John and Steve, I think, referenced being a tough market to write business. Anything you'd add?
Right. Well, we're living nearly everything that Jonathan just mentioned. I would say, however, we felt a little bit less pain on the practice program renewal, bearing in mind that our portfolio is mostly New York centric, all pretty much within the Northeast. Within our organization, we have another construction business, which is non-New York for the most part. However, even on their practice program renewal, the lead excess numbers were coming in double-digit increases. So yes, we've seen it across our practice programs for sure. We've definitely seen it across our contractor controlled insurance programs. As John touched on, the attachment point has changed over the last several years, and the 5-10-10 is pretty much the mandate. And with that comes other factors. So the aggregate rates are higher in addition to paying more premium. we're taking on a little bit more risk. I can say that over the last couple of renewals and couple of project placements that we've gone through, that there's more due diligence in the underwriting, whereas previously, maybe perhaps not that much, there was underwriting, but it's sort of taken it to another level. I've noticed that the credit divisions from the carriers like to get a little bit more involved. So there's a much more due diligence going on as well. But in addition to the increasing on the deductibles, we've seen our deductible structure on our CSIP program nearly quadruple over the last couple of years. And again, with that comes heftier collateral requirements and higher aggregate rates under those programs.
Thanks, Mildred. Hard market, anything you'd like to add?
Yeah, there's some instability, I'd say, or a lot of change in the owner GC project specific market. I'd also say it's becoming increasingly more expensive, if not impossible, for subcontractors to obtain insurance that meets the minimum requirements. So managing those types of programs is more onerous than it's ever been before.
Thank you, hard market. So we'll move on, and are we all feeling the same pain? Does the hard market effect vary based upon insured size, territory, or class? Mildred, let's go back to you on this one.
Sure. I think that we're all feeling the pain, and speaking on behalf of a large contracting organization and having quite a bit of interface with our smaller contractors, this is certainly something that is felt across the board. Hold on, someone's trying to call me. Sorry about that. So the smaller contractors are having a harder time getting the insurance that's required. And there's generally a push to put together wrap-up programs, whether by the owner or the contractor. And we're certainly feeling the pressure from both sides, from the ownership, from our leadership, and from our subcontracting community to put these programs together at what is deemed a competitive cost, and certainly managing the expectations of those around us as to what the reality is by way of pricing of these programs. So it is, I would say it's something that's certainly felt across the large contracting community as well as the smaller contractors.
All right, thank you. And let's move on. So as mentioned earlier from this hard market, we do anticipate future growth of the wrap-up product, specifically GL onlys. From a cost perspective, despite the wrap-up excess market being hardened and seeing rates increase, the same is applied to the cost of excess insurance for contractors, balancing the cost offset of the wrap-up. The other reason for the expected increase in GL only wrap-up placements is the fact that they provide the project with costs fixed for the construction term, avoiding continued market fluctuations, but also solve the concern of finding subcontractors with adequate insurance, both from a limits and coverage perspective. Bryan, anything you'd like to add on this topic?
So we put in place a rolling GL only OSIP back in 2017. It's basically just an easier program to implement internally. We negotiated, lower deductibles. So it was a $25,000 deductible with, a deductible cap on the program. So, and there was no collateral requirements. That's a huge hurdle when you're dealing with a company that doesn't want to tie up capital for a while. Also, there is no volume commitment over a period of time. So when you implement a rolling wrap-up program, you usually have to commit to a minimum construction volume over the policy term. But we didn't have to do that here. So those were two of the big factors that helped push our company to make the decision on implementing a rolling GL only OSIP.
Thanks, Bryan. Yeah, definitely agree. I mean, we like to call on the CRS side GL only's wrap-ups for rookies. Definitely lower barriers to entry, as you reference, smaller job size threshold to qualify, small SIRs, no collateral, and different appetites coming from the E&S market. Hard market, anything you'd like to weigh in on this topic?
Yeah, I'm a really big fan of using the geo only solution when it makes sense. I think that using geo only, as Bryan touched on, allows you to have some options that are better for cash flow, no collateral requirement. You can, even in New York, you could front the general aggregate and risk transfer completed operations. It's very favorable to owners. It allows you to be more creative with your aggregate structure, which does push the cost of the excess up, but you save quite a bit of money below. So really using those types of solutions allows you to be more creative, especially if a project is medium size and may not be quite large enough for a huge dual line wrap.
Thank you, Hard Market. John, anything you want to add on this topic?
Yeah, I think exactly what everyone's saying is the overall competitiveness of this product. When you look at the grand scheme of the hard market, this is probably a product that's the most competitive. There are plenty of players doing it. There's all the terms and conditions are somewhat standard. So I think it's a very good option for owners. It's really not available in New York for the most part. There are a few exceptions to that, just based on the fact that the carriers wanted to control, the workers' comp. But the trend of insurers using this product outside of New York has been there, and just would expect that to continue in this market.
Thanks, Sean. So moving on, I think it'd be very remiss of us not to mention COVID and the effect it has had on the hard market. Bryan, you want to jump in on this topic?
Yeah, so in addition to obviously the hardening and excess market, COVID jumps in and adds fuel to the fire. And it really came down to two factors with COVID. The economic downturn caused interest rates to drop, which in turn drove down insurance carriers' investment returns. And then the second factor is the uncertainty of the claims payout. It's still highly unknown, what that's going to be. I've seen estimates between 50 and 80 billion. That's a huge range. So, underwriters and actuaries are underwriting the worst case scenario. And, it's a huge hit to the market that just adds fuel to the fire.
Thanks, Bryan. John, anything from a carrier's perspective on this topic?
Yeah, so on a carrier's perspective, we've been seeing the use of the communicable disease or exclusion pretty much across the board from almost every carrier. It's in the E&S space, at least, it's kind of become a norm. And we're starting to see a lot more on the large standard, markets. There's exceptions that are made we've seen exceptions on super large risks, super large carriers that have a relationship with the standard market for 10 years. They may remove the exclusion after quoting with it, but for the most part, we're seeing it all over the place. The exclusions from an admitted basis are a little more difficult just based on carrier filings, but I would think that the outlook is going to be, you'll see the communicable disease exclusion becoming a normal exclusion, similar to maybe asbestos on the go forward.
Thanks, Sean. We're going to stick with you on this next topic. This is a question submitted to us prior to the webinar. Should we be looking to our brokers to seek out quota share for excess levels, and will that give us a more economical price versus single carrier?
So I don't think the approach necessarily helps with price in such a dramatic way, but I think it's a good way to help manage capacity when you're building a large tower. You could probably get increased capacity from a carrier in a quota share layer than you would otherwise. Just the spread of risk over the larger stretch is such a more attractive way for a carrier to be willing to put up more capacity, which is obviously needed in the market right now. But again, I'm not so sure there's a discounted premium associated with this, just based on the fact you have the per million layer pricing requirements from carriers that are higher, than they ever were. There's also some carriers that completely shy away from supporting quota share layers, or just shy away from supporting quota share layers when down low. Underwriting concerns such as controlling the claims process is pretty much the reason behind it. But using a quota share down low where the bulk of the premium would be an effective approach, but I think it's very difficult to make that work. And but with all that being said, on very large projects, quota share opportunities for carriers when you're X of 100 million are there. We've also seen sometimes X of 25, X of 50. Their brokers are now starting to put quota share layers together to try to achieve a better price and try to reduce costs. So it's definitely a tactic that brokers and clients are using right now.
Thanks, John. Steve, any input on this topic?
No, I think John hit it there. If I'm reading this question, assuming it came from a client, should we be looking to our brokers to seek out quota share for excess levels? Will that give us more economical price versus a single carrier? Yes, most likely, potentially. To John's point, there are some carriers who may not want to be in a quota share position, and there's a few reasons for that. And I think it could just depend on the deal. It could, to John's point, depend on the attachment level. But from a carrier's point of view, when we're in a quota share, and particularly when we're in a quota share down low, right, you give up claims control, and that's not ideal. And you potentially give up pricing control as well. So it may work. This may be a solution that may work in the short term, but between terms, conditions, and pricing, if it fits for 1 year, it may not be sustainable for subsequent years, depending on what happens with the market, what happens with loss history. And so it's a bit more challenged to get done when I'd say you're below 50 million. But it does make sense if you're a carrier that doesn't want to put out 25 million extra 25, but you want to put out 25. If it stretches out to the $100 million layer, it may make more sense to do something like that. But again, I'm just concerned about the long-term viability of it.
Thanks. And Steve, we're going to stay with you on this one. And I think this is the question everyone kind of wants to know the answer to. When will this end? When will this end? Please make this end.
All right. So a lot of pressure here, but I would say this: unless you think that claims costs are somehow going to decline, there's no reason to believe that current pricing and structural levels aren't here to stay. So what we're really getting to is a new normal in terms of commercial insurance pricing and program structures, right? I mean, rates can't always go up, right? This isn't the stock market, and eventually pricing will start to level off and stabilize. And I do expect that to happen at some point here within the next 18 months. But when I say stabilize, I don't mean they're going to go back to levels from pre-2018. And if you want a really good case study into what's happened or what is happening, look at the New York construction insurance market over the past decade. In 2011, the excess markets increased their rates, they increased their attachments, they decreased their capacity. Primary carriers were asked to put up higher limits, and therefore they increased their retentions. They were feeling the losses as well. And everybody was trying to find new and creative ways of putting program structures together. Buffer markets became a thing, right? 2-4 limits with a lead 25 just went away, and it effectively went away overnight. And you look at what New York has become over the last 10 years, that hasn't changed, right? The level of program structures, the limits that are put out there, the pricing has stayed relatively consistent, even though New York has been challenged for a whole host of reasons. And so I would argue that what happened in the New York construction insurance market a decade ago is a microcosm of what's taking place just on a much broader scale. And we're talking about construction, but this isn't just a construction conversation. This is what's happening more broadly in the casualty markets.
New normal. Thanks, Steve. John, anything you'd add?
Yeah, I don't think it's going to change much on the go forward. Totally agree with what Steve's saying. It's becoming a little bit of a new normal. But to be honest with you, we've actually seen hardening of rates in certain areas, fourth quarter 2020 into first quarter 2021. So I think the trend is still moving upwards. What's happening now in the markets, especially in New York, I think there's a lot of new entrants into the space. So we might see the stabilization occur a little quicker. This new capacity is obviously being aggressive on these opportunistic areas, New York GL buffers, AL buffers, residential opportunities, tougher lower layer placements on tougher classes of business. So just maybe depending on how long that capacity stays in the market will determine how much longer the market will last. But for the most part, I think we're sort of at a norm similar to what Steve is saying, and I wouldn't expect things to go backwards, or I wouldn't expect, or clients probably shouldn't expect rate decreases over the next year or two at a minimum.
And just to something that Bryan had mentioned too, I mean, what happens with COVID-19 litigation over the next couple of years, you know, for some longer tail classes of business, that potentially could have an impact on what happens more broadly too. And in some cases, you're seeing, you know, the retroactive changing of the statute of limitations. This isn't necessarily a construction issue, but it impacts the insurance industry more broadly. What we saw most recently in the revisions for the statutes on, you know, sexual molestation cases, which is, you know, it's obviously something we should all applaud, but that's going to impact the balance sheet of insurers who didn't have reserves put aside for cases that are going to get opened up for, you know, things that happened many years ago. So how
Good
all that
point.
shakes out could also have an impact.
Thank you, guys. So just another reminder to submit any questions you have for myself or the panelists before we hear some solutions on how to deal with this hard market. But here are a couple solutions that we all came to as a panel. One solution that we discussed was primary structure adjustments. John, do you want to talk on that topic?
Sure. So, you know, for excess pricing, putting together a primary structure that gives your excess carrier the most comfort is the way you will get your most competitive price. Excess traditionally was purchased to protect against catastrophic events, but in recent years, excess layers have become working layers. So if your primary carrier is providing what your excess carrier thinks is sufficient aggregate, whether it being a reinstating general aggregate on a project, multi-year project, or a per project aggregate that doesn't have a $5 million cap or a $4 million cap with a 244, which is what we've seen. I think without those in place, you'll get your most competitive deal. Also, the idea of the corridor deductibles have been an avenue brokers and insurers have been trying to explore to alleviate pricing, but we really haven't seen those work. I think they may only work in really extreme situations, but again, we really haven't seen much of that come into play yet. But another quick solution, I think, to help stabilize overall pricing is using the same carrier that you would use for your primary and your lead excess. So lead excess markets are always going to be their most comfortable writing over themselves for all of the underwriting reasons you could imagine. Claims management, your overall company being closer to the client, faith in your own company's loss control. So an excess carrier is always going to be the most comfortable over themselves. And I think that could also lead to better price on the overall for your client.
That's a great comment, especially carriers that have a coordinated claims approach for handling both the primary and excess claim situation. Right. Hard market, anything you'd like to add on this?
Yeah, I think I'm not so much afraid of the discomfort of the excess underwriters. I think sometimes increased premium on the excess is worth it if you have creatively restructured your lower layers and you save money on the aggregate reinstatement or on your collateral, so you have more money to work with. I really think in general, this market needs to explore the non-admitted world very aggressively where it can. There just are situations where geo-only structures make sense, where not having annually reinstating limits makes sense. Not every time, but I just want to make sure we're calling attention to alternative and creative solutions in addition to more aggressively structuring in the admitted market as well.
Thank you, hard market. Now, Mildred, you alluded to this earlier, but how about insureds taking on more risk? How has this become a solution?
Right. I'm not sure if it's a solution or more of, I guess, an assumption of things to come. But we've, over the last several programs that we've put together, we're taking on more risk. Whereas we perhaps had a deductible of $500,000, we now have a deductible of $2 million. In addition to that, the aggregate rates for these types of controlled programs have also tripled and quadrupled in what we've put a program together 10 years ago. The ag rate was a quarter of what it is presently. The one, I don't want to say benefit, but I think the one item I'd like to just bring up is that when you're talking about these large loss sensitive programs, I think it really helps to get the attention of others around you and those in executive leadership, because once they start hearing a deductible excess of $2 million, it really helps to, I think, invest back into the loss control and maintaining aggressive claims management. And I think that helps to support it, because at the end of the day, yes, we're taking on more risk. Under a CSIP program, it's not just my risk, it's the risk of all of the enrolled subcontractors. So we're essentially providing a product for everybody. And I think that that helps to sort of rally everyone for a greater focus with respects to loss control, and really working hand in hand with your insurance carrier and your broker to ensure that, you know, we're doing everything we can to mitigate the loss or possible losses. And then managing that on the back end with the claims. I mean, it's one part to put together a program. It's everything that happens after that, I think, that also gets factored in.
Thanks, Mildred. And Bryan, John spoke a little bit about corridor deductibles or retain limits, but anything you wanted to add on that topic?
Yes, like John mentioned, it's only really feasible in very unique situations where the lead excess layer is extremely expensive compared to the limit that they're putting up. And it's a good idea to have a quote option for a carrier, a lead excess carrier with a corridor deductible option. Basically, it's a deductible on the lead excess layer that's fully funded, and it's one hit to the program, meaning that it's a one occurrence and aggregate deductible hit. After that, the excess layer drops down the first dollar. When I say it's fully funded, you would usually set up a trust between your bank, ourselves, and the insurance company, fund the full deductible amount for future claim payouts. You know, when you're comparing different options at your renewal, you want to include this and compare, you know, the overall premium of full risk transfer versus this option. And then eventually, if you go with that, the corridor deductible option, you want to develop a rate that fully funds that deductible as well for external pricing. You know, this option reduces the excess layer pricing, because I see that you have some skin in the game, and you know, like Mildred mentioned before, you're wanting to protect your capital with better safety improvements and claims handling, whether it's, you know, investigations at the site, you hire a third party investigator yourselves, or, you know, have defense counsel go directly out to the site and collect statements and do your whole full safety analysis.
Thanks, Bryan. So GL only wraps was another solution. Hard market, do you want to weigh in on this?
Yeah, I mean, we kind of touched on it. I think GL only allows you, I think, on certain medium-sized projects, 500 million, 600 million in New York, I've seen that, you know, putting defense inside the limit and fronting the general aggregate, risk transferring completed operations on a guaranteed cost kind of way, having a couple of reinstatements managed, and then building a single excess tower above that. It does make the excess more expensive in parts, but by managing the aggregate and getting rid of the unknown and taking so much of it, you know, taking all the pressure off the bottom layer only, it has saved money, and it is more favorable to cash flow, because the general liability part doesn't have any collateral requirement. It doesn't work on all projects, but it works on a lot. And this is kind of going back to what I said earlier, where you should always be asking your broker to look into non-admitted solutions in addition to admitted solutions.
Great, thank you, Hard Market. And to the comment I made earlier, you know, the GL only wraps also allow you to lock in rates, so you're kind of avoiding some market fluctuations if the market does continue to trend worse. And it also alleviates concerns of the uninsured subcontractors. So we view that as another solution. Investment and risk management, Steve, can you comment on that?
Yeah, I mean, sounds like a pretty obvious statement, but I'm looking through some of the questions that were posed in the Q&A. I'm we obviously haven't gotten to them all yet, but there have been more than a few comments around construction technology or emerging construction technology. And I think that's kind of where this fits in to some extent. And so I want to address it from that angle. There's a lot of emerging construction tech that's out there, whether it's wearables, whether it's IoT sensors or artificial intelligence. And right now, it's very difficult to say what kind of impact these tools or products are going to have on loss costs. I think we're actually starting to see some positive impact, at least as it pertains to shorter tail lines of business. So thinking about property or builder's risk, where you can figure out what your loss costs are going to be over a shorter period of time. But when it comes to workers' compensation and general liability and subsequently excess casualty, it's going to take a number of years to play out in terms of the impact, at least from a loss cost standpoint, in terms of what these products or what these emerging technologies will have. But doing something is better than doing nothing. And I will tell you that it's very hard for us objectively, from an underwriting standpoint, to figure out what that discount would be for using a new tool in the construction space. But subjectively, it does have an impact, right? If you're just doing the bare OSHA minimum and not trying to get in front of these industry trends, the renewal cycles are just going to continue to get more difficult. And if you're really studying where you have consistent loss drivers, where you could have potential issues, and you're looking into new and innovative ways to address it, and that's where emerging technology comes in. That's where things such as predictive analytics come in. It signals an approach, a behavioral approach, right, to the market, to the underwriters that subjectively can go a long way. But like I said, the technology space right now, it is really fragmented. It comes down to the individual contractor, the program, the problems that you're trying to solve. In some cases, it's a hammer looking for a nail. But doing something is better than nothing. It's just a matter of time, I think, until these products become more mainstream.
Thanks, Steve. So now we're going to address any questions received prior to the webinar and other received today. And I see quite a few came in while we spoke. If we're not able to get to all the questions, we'll be emailing everyone a PDF with the questions and answers from today's sessions. So one of the questions that did come in prior to the webinar, which did give us some prep time to answer, is what are the long-term impacts of broker-driven exclusive MGA programs in a hard market? Do you see broker-exclusive MGA programs shortening the length of the hard market or negatively impacting the need for higher rate adequacy for capacity limits? Steve, you want to answer that one?
Yeah, this is, I found this question to be really fascinating. And so will broker-exclusive MGAs make the market more competitive sooner, or will it have a negative impact in producing what the industry needs, which is effectively better pricing adequacy? And there's a lot of layers to this, and it depends on a few things. And when you're talking about insurance programs that need to have hundreds of millions of dollars of limit in place, I don't really see MGAs, even if they're pricing business aggressively, as having a significant impact in the aggregate. Maybe there'll be some examples of one-off programs, here or there, where the pricing was a bit too aggressive, but even so, a lot of it comes down to the business model and the underwriting model and how MGAs are incentivized. I mean, regardless of who the MGA is owned by or who it has an exclusive with, there needs to be paper that's going to support the MGA, and what parameters are in place by that paper to ensure that pricing adequacy goals are being met, right? If MGAs are only incentivized to produce top line revenues and transact business, then there is the potential for some longer term problems that certainly exist. But a lot of it really all comes down to an alignment of incentives. But and not to knock on MGAs, because MGAs can be a really efficient way to transact, and as a result, reduce expenses for carriers, especially for highly specialized risks such as construction. If you take a look at the annual reports of all the major industry players, expense ratios tend to run anywhere from 27% to 35%, sometimes even higher. And yes, losses have been bad and pricing corrections are needed and they're justified. But we as an insurance industry, we also need to look at ourselves in the mirror and figure out how we get better on the other side of the equation, right? 30% expense ratios, it's just too high. There are a lot of inefficiencies in the traditional insurance and distribution model, and it needs to be addressed. I think, Jeff Bezos said it, your margin is my opportunity, and there is margin to be had there on the expense side. And that is an area where I think MGAs can address.
Thanks, Steve. John, anything you'd add on that?
Yeah, I think Steve answered it. The exact, my thoughts are exactly the same. The one thing I'll add is the MGAs. There are successful ones, but when an MGA is put in place, they're there for a certain layer, a certain limit. So if you're building a GL on a $100-200 million tower, an MGA is really not going to be able to impact too much of that, aside from maybe one piece of it. So maybe it'd be the GL, maybe it'd be the lead excess. But the difficult thing for an MGA is that they really have to earn the trust of experienced buyers, just because of the fact of the history of what you see maybe with an MGA, where basically just taking advantage of a market condition. Not that they all do that, but there have been market MGAs that just come in and out of the market, and an experienced buyer who wants to create a relationship with a long-term carrier, that probably isn't the route to take. But that being said, there's several successful program markets that have been in the space for many years that they do a real good job with claims handling, managing the risk transfer piece properly, and also providing in some cases some meaningful loss control.
Thanks, John. Now, before we continue, I see a couple of the questions were answered via chat, like people on the panel had written anything back to the panel. So are there any questions there that you'd feel comfortable jumping in and answering, or otherwise I think we'll close and we can send out questions. We can send out responses to these. So
Josh, I had a quick, I had two I can answer. One of which was respects to captive solution. Speaking on behalf of Tishman, we do have a captive insurance company that we established about 20 years ago now. And we utilize our captive to ensure the risks of our contractor controlled programs, our SDI and our practice program.
Hard market, we got some feedback from you. Sorry.
That's okay. And there was another, with respects to posting a bond as an alternative form of collateral. I'm only speaking on that because we recently put up there was a large collateral ask, and the carrier was willing to accept a small portion of that as a surety bond. But historically, we have never usually, they haven't really been agreeable to posting a bond for collateral, but that's just been in our experience at Tishman.
Thanks, Mildred.
No,
Any of the other panels?
I would just say on the captive question, not really directly a captive, but some of the global markets utilize their paper in a way that's almost like a rent a captive, where they're willing to kind of put up a policy for a staller, but it is the insured pays it themselves in the form of, I don't know, like an escrow account, some alternative to normal collateral. And it does really resemble a kind of a rent a captive, but it does put paper on the project and allow you to build an excess above it. It's kind of the closest thing outside of an actual captive that I've seen.
Great insight. Anyone else, or? Okay. All right. So moving on, as mentioned, we'll send around all questions and answers so everyone can see them. So moving on, to learn more about future webinars and to access our latest white papers, follow us on social media. We are active on Facebook, Twitter, LinkedIn, and Instagram. Stay tuned for TikTok. If you're interested in learning more about wrap-ups, or if you're wondering if a wrap-up is right for your project, reach out to us through our contact information here. We are always available to answer your wrap-up questions. Our website offers opportunities to learn more about wrap-ups and to register for a demo. We can put together a no obligation quote for your project and schedule a call. Last, I want to thank everyone who joined us for today's webinar. Steve Buonpane, Mildred Claire, Jonathan Luca, Bryan Paul, and our special guest, the Hard Market. Thank you all for sharing your insight and expertise. We hope this webinar has helped provide some insight into the current excess hard market being experienced, and has more importantly provided some solutions that can help stabilize your insurance costs going forward. Thank you. Stay safe and healthy.
Thanks, Josh.
Thank you,
Thanks,
Josh.
everyone.
Appreciate you having me.